Welcome to The Explainer. Today, we're going to talk about a word you hear all the time in business, audit. We're going to break down what it really is and, why it's pretty much the foundation of our entire economic system.
All right, so let's just jump right in with a really basic question. Think about it. When a company puts out its annual report, it's packed with all these numbers about profits and performance. How do you know any of it is real? How can you trust what you're seeing?
And that question, right there, gets us to the heart of the problem. See, on one side, you've got the shareholders. These are the people who actually own the company. But on the other side, you've got the directors, the managers who are hired to run the thing day to day. And because the owners aren't the same people as the managers, this trust gap just naturally appears.
Now, these directors, they have this really important duty called stewardship. All that means is they've been entrusted to look after property, all the company's money and assets that actually belongs to someone else. In this case, the shareholders. So this whole setup creates what's known in the business world as the agency problem. You've got the owners, who are the principals, and the managers, who are their agents. And it all boils down to one central question. How do the owners make sure their agents are actually doing a good job? How do they hold them accountable for that stewardship?
And this is exactly where the auditor steps in. Seriously, their entire job was basically invented to solve this exact problem, to bridge that trust gap we were talking about. So, what is their mission, really?
Okay, this quote really nails it. The auditor's job isn't to make the financial reports. Nope. Their mission is to give an independent, expert opinion on whether the reports that management put together actually give a fair picture of the company's performance.
And this leads us to a really important idea: reasonable assurance. See, an audit gives you a super high level of confidence, but, and this is key, it's not an absolute ironclad guarantee.
Right, an audit is not a promise that every single number is 100% perfect. The goal is assurance, not absolute certainty. And there are some very real practical reasons for that.
So why can't it be a total guarantee? Well, because of what we call inherent limitations. For example, what if management deliberately hides something? Or think about a huge company. It's literally impossible to check every single transaction, so auditors have to use sampling. And a lot of the time, the evidence they find is more persuasive than it is totally 100% conclusive.
Okay, so if there are all these limitations, how in the world can we trust an auditor's opinion? Well, it's because they follow a super strict playbook. Let's dive into the core principles that guide every single thing they do.
It really all comes down to this professional playbook that's designed to make sure the audit is done with absolute integrity. It's this mix of a critical mindset, a focus on what's truly important, and, of course, a rigid code of ethics.
So the first thing, and you could argue it's the most important, is a concept called professional skepticism. Now, this isn't about being cynical or negative. It's a professional mindset. It means having a questioning mind always.
So what does that actually look like? It means an auditor can't just take information and accept it at face value. They have to critically look at the evidence, be on the lookout for anything that doesn't add up, and be ready to challenge what management tells them. It's a fundamental part of the job.
And that professional skepticism is guided by another huge concept: materiality. This is what helps auditors focus their energy on what really, truly matters. Basically, a piece of information is material if an error or leaving it out is big enough that it could actually change the decisions of someone reading that report.
Let's put it in even simpler terms. Is the mistake big enough to change an investor's mind? An auditor isn't looking for a $10 mistake in a billion-dollar company. They're hunting for the kinds of errors that are significant enough to make a real difference. That's the bar for materiality.
And holding all of this together is a super strict code of ethics. Every single professional accountant has to follow these 5 fundamental principles. We're talking about integrity, objectivity, competence, confidentiality, the whole shebang. It ensures they act professionally at all times.
All right, so now we've got a good handle on what a financial statement audit is, but it helps to zoom out a little and see where it fits in the bigger picture. You see, an audit is actually part of a much wider category of services called assurance services.
And the goal for all of these services is pretty much the same. You have an independent pro come in to improve the quality and trustworthiness of information. The whole point is to give decision makers more confidence.
And this comparison here is a perfect way to see the different levels of assurance. On the left, you've got a full audit. That gives you a high level of reasonable assurance, which leads to a positive conclusion. Something like, in our opinion, the statements present fairly. But on the right, you have a review. It involves way fewer checks, so it only gives a lower, limited level of assurance. And look at the conclusion. It's negative. Nothing has come to our attention. That tiny difference in wording, it means everything. So, all of this work, the skepticism, all the testing, the ethics, it all leads to one final, super important document. This is the thing that finally bridges that trust gap we talked about at the very beginning.
And it's called the Auditor's Report. This is the formal written communication that goes from the auditor straight to the shareholders. Now, it has a lot of detail in it, but there's one section that is more important than all the rest combined.
And here it is, the payoff, the opinion. This single phrase right here is the whole reason the audit even exists. When an auditor says that, in their opinion, the statements present fairly, what they're doing is providing the confidence that allows our entire financial system to work.
So as you can see, an audit is this incredibly powerful tool for giving us confidence in what has already happened, which, leaves us with one last fascinating question to think about. If an audit builds our trust in the past, what tools do we have to try and assess a company's future?